This is Digital Perspectives with Brad Kimes. Subscribe for new content notifications. Now, here's Brad Kimes. Come on in.
I'm back, and look who I got with me. It is David. David Cryptpolis. How are you, my friend?
I'm doing fantastic, Brad. How you doing? Hope everybody out there is safe and doing well.
Hey, I'm doing great, and I hope they are too, no doubt about it. And, look, we got a lot to unpack today. I saw the post you had, and it was about, hey, the playbook for the 1929-1933 Great Depression is still on the table. We got to talk about that. And then one of the things we want to cover too is that you had another post that you talked about all the economies in recession currently right now. We got to talk about that. We got some Maxine Waters information and video we got to talk about. And shout out to Beaches for sending that clip to me earlier. And then we got to talk about all the Italian banks that are going to be on Quarter platform by the end of this year, as David Rudder likes to say it, hundreds of millions of transactions by the end of the year on Quarter. I don't know. You tell me, where do we want to start here, Dave?
Well, let's go to the world economy. The chart that I put up on Twitter.
Got it. Here we go.
Because that is, I think it's really striking. And it's kind of an overlay on just about everything else that we're going to be talking about. First of all, this chart came to me by the way of a very, very smart bond guy by the name of Lacey Hunt. And he is just like, I mean, if there's anybody who understands macro, the bond market, and, everything is going on in the world economies, he's the guy.
Okay.
And I failed to give him credit in the tweet, which was my error. But this chart is from his newsletter that he puts out for his clients. And it's the world economy from 1871 to 2020. And so you got about 130 years there, right?
Yeah.
And if you take a look back to the left side of the chart from 1871, you can see we had a couple of spikes in like 1914 to 1918, where we had about 70% of the world economies in recession at that time. We go to 1929, 1931, we're at 83.8%. And that was the highest until this year, when we go over to 2020. Estimated 92.9% of the world economies are in recession currently. And that is through data up until August. And so here's why this is kind of really important. We know really what's going on, because the economy basically shut down in March. But the truth is that we have been in fact, it's even higher than the great financial crisis, right? If you look at 2009, it was at 61.2%. So at 92.9% currently, this is important information, and there's a bit of a delay in recession and stock market data and the way the stock market reacts to this kind of data, because there's always hope, right, that we're going to come out of this faster than people think. And we have been, so many people have discussed the fact that, they're working on vaccines, they're working on this, they're working on that. And now we got the news this morning that President Trump has been tested positive for COVID-19.
Oh, that's right. Yeah.
And so that's it's kind of a big deal. And so, I don't think this thing is going to go away anytime soon. I would be very happy and very surprised if it did. But I think the vaccine is going to be another year or two out. And so we're going to be dealing with this for a while. The fact that all of these economies, here's the big picture here. The big picture about the fact is that previous recessions in the world typically only hit one or two countries, or maybe a half of the countries in the world, but not all of the countries in the world, not 92.9%. Because what happened in previous recession is the stronger economies, let's say China went into recession, the U.S. is doing okay. Well, the U.S. could bring up the rest of the world because their economy is doing well. Or if the economy hit a recession in the U.S., maybe China or the UK or another country could bring up the rest of the economies in the world, and still, there's a good amount of development and production in the world, so that we didn't fall into a deep world recession. Well, in this case, we have 92% of the countries in the world in recession. There's no country that's strong enough at this point in order to bring up the economic situation of the rest of the world. There isn't a major country out there that isn't in recession that's going to help support the world economy.
Well, let me just, this is a sobering moment you're talking about here. Who in the hell is going to pull who out of the hole then?
Yeah, so it's not going to happen. And so what we're going to see is additional quantitative easing by the Federal Reserve. We're already getting $82 billion a month, and I think we may end up going to $100 billion or even higher as the economy continues to move higher, which means that, well, there's two things that are really, when we talk about the fact that the Federal Reserve is doing quantitative easing to help relieve financial conditions, to stimulate the economy, they don't really stimulate the economy at all, because that money just doesn't go into the system. It's the commercial banks that are really the ones who are printing the money. If we're talking about printing money, it's the commercial banks. But what have we seen over the past 6 months is a contraction in lending. People are not interested in going out and borrowing money right now. This is a time where most people are putting money away. They're not really trying to spend it. They're trying to save it. And so the contraction in real lending which is where the economy gets its strength from. If we really look at the economy, we're a debt economy. And in order for the economy to move forward, we need an expansion of credit, not a contraction of credit. And we've only seen a contraction of credit going forward. So that's a very much a deflationary scenario for the economy. We've also had a contraction or a expansion in defaults, personal loan defaults, and we've been in forbearance, remember. A lot of people have gotten forbearance on their mortgages and student loans and things like that haven't come due yet, but they will be coming due. They're going to have to start making those payments again. And so, I think that going forward, we're going to be in really rough shape. In fact, Maxine Waters, which is a clip that you sent me this morning, about talking about, what this new stimulus bill will includes a lot of domestic spending, especially in low and moderate income areas, in order to help stimulate some sort of, recovery here. But she also had a little bit of a surprise in there.
She did, and we're going to play some of that clip right now. It is 5 minutes of domestic nightmare. And to your point, it really is, renters are in a hole and mortgage holders are in a hole, and it just goes on and on and on. It's like, wow. By the time you get done listening to it, you're like, whoa, what is going on? And at the very end of all of this domestic nightmare, she references, let's just listen to it. I'm going to start it at 4 minutes and let it play through. Here we go.
And MDIs to bolster financing activity in minority communities, which have been hardest hit by this pandemic. I'm so pleased that the bill provides another round of stimulus payments for families, additional funding for small businesses, including $120 billion for restaurants and airport concessionaires. And importantly, the bill directs the Treasury Secretary to work with the global community to immediately provide $2 trillion in relief through the International Monetary Fund, which will immediately support development.
Now, you tell me, Dave, we just went from the domestic talk to encouraging the Secretary to release $2 trillion to the International Monetary Fund for other countries that are getting hit. Now, that $100 billion for small business owners, look, they're the ones that really got pummeled, those small business owners, during this deliberate shutdown of the economy.
Yeah, especially the restaurants, anybody who's doing concession serving of any kind.
Yeah, absolutely, right? Yeah. So, speak to this a minute. This is odd.
Yeah, so I'm always skeptical when somebody tells me something and they try to sneak it in at the very end of the conversation. That's the one I really pay attention to. That's kind of perks my ears up a little bit because they're saving the best for last. It's like the cherry on top of the ice cream sundae. They really want to save that, and relish it at the end of the dessert. And so I'm always a little bit like, that's the one I should pay attention to. All the other stuff is kind of like, hey, I'm leading up to this, and maybe you've already drifted off and you weren't really paying attention. Now I got to sneak that one in there, So I paid attention to that. And one of the first thing that came to mind was the fact that we have because the Federal Reserve is really the central bank for the entire world, and the monetary policy that we set in the United States affects almost every single country because we are the reserve currency, right? So the US dollar is the reserve currency of the world, and whatever we do as far as our monetary policy goes set by the Fed affects almost every single country. And that's one of the reasons why we've had a number of swap lines set up with central banks around the world. We have lent them this US dollars because there is a shortage of US dollars across the world. We've talked many, many times about the fact that the majority of debt in the world is denominated in USD, and they need that USD in order to pay their debts. And so when that happens, and I hear that she wants to allocate this $2.2 trillion to the IMF, going to developing countries. Well, the ones who need it the most are probably the ones who went to the Federal Reserve in order to get these swap lines because it was the only lifeline that they had at the time. And so now the IMF is going to step in and say, hey, look, we've got to support these developing countries. So the IMF probably went to the Federal Reserve and said, look, you've done what you could. Now we need more help. And that was kind of part of the testimony that, Jerome Powell gave to Congress last week, is that, hey, you need to do more stimulus. And it wasn't just domestic. It was international at this point. And so, I mean, can you imagine the kind of chaos in the world that would ensue if we did not help support some of these developing countries? That would fall into absolute chaos. And so because the Federal Reserve does control really the monetary policy of the entire world, if they don't have the dollars they need in order to make payments to the U.S. because of loans, things are going to be even worse than they are right now, and they're already bad.
Yeah, they really are. It's pretty scary, to be honest, trying to project and look ahead and see how does this exactly play out. I mean, we know that we have, what do they say? History may not repeat itself, but it rhymes.
Yes.
And I get that, but like, how does this play out? I really do feel like, boy, they've created a situation that I don't even know if I certainly, concur the Great Depression, the playbook is there, what they're doing and all of those things. But I think we're at a depth and a level that is even beyond that as a reference point. What happens? How does this even come out? I don't even understand how this comes out.
Well, that's something that I've actually spent quite a bit of time on over the last few weeks, trying to determine how this is going to play out.
Right.
The most important thing that we talked about and previously is, in fact, the bond market. The bond market drives the entire world. It's so much bigger than the stock markets of the world. It's nearly everything when it comes to monetary policy. And all you have to do is look at the 10-year yield rate and the 30-year yield rate in order to determine what's going to happen in the future. Now, we know that the Federal Reserve is buying up $82 billion in treasuries in the short term, and they're leaving the long-term rates and long-term end of the yield curve, and they're leaving the short-term rates to the commercial banks. Now, strangely and oddly, we have $82 billion that the Federal Reserve has been using to buy up as much of the long-term debt as possible. And we have seen interest rates just go sideways. And one of the reasons why it hasn't really had an effect on longer-term interest rates is because commercial banks have not really gone out and extended they haven't eased credit to small businesses like the Federal Reserve really wanted them to do. And so, in fact, they've restricted credit in some cases. They've contracted credit. They've tightened up lending standards. And so, what happens is when you get a contraction like this, even though the Federal Reserve is buying up as much Treasury bonds as possible in order to keep rates low, the banks haven't followed suit. And so, the banks are really telling the Federal Reserve at this point, "Hey, look, we know the economy is in bad shape. We don't see the credit worthiness out in the marketplace. We have to, restrict restrict the credit that we're extending because there aren't any credit-worthy borrowers out there." Well, where can they show us where the money is to repay?
Well, yeah, because the economy's been deliberately shut down. Most people were out of a job and they can't. Yeah. So how are you going to lend to the banks and then the banks lend to the customers? It's a chain reaction. We saw this similar in collapse, and breakdown in this in 08, right? I mean,
That's correct.
They had the interest lending programs and the interest, mortgages, and they let everybody go run it right up to the moon. And when everyone started to default, what did they do? They changed the credit criteria and the credit structure. So now the height bar to get out of that interest only loan was not something you qualified for like you did 3 years or a year and a half before. And now you were screwed and you're foreclosed on, and then BlackRock buys $50 billion worth of real estate. Currently, right now, the Federal Reserve holds 30% of all mortgages.
Yeah, that's right. And I've heard it's high, a little bit higher than that even.
Jeez.
They're getting close to 50%. And I think probably by the time we're done, they're going to be close to 65, 75%. And there's also a couple of other interesting statistics is about 65% of the income that people are receiving in the United States right now is government supported. So, I mean, with the stimulus checks and the unemployment insurance and all that, it's a very, very high rate. And so we have unprecedented spending by the federal government. We have a contraction of credit by the banks. Now, one of the points I wanted to make about the banks contracting credit and restricting the lending is that we've had lower rates, but we've had this restriction. Just like in 2008 that you mentioned, banks were they were giving loans away, and interest rates at that time were like 4 or 5%, maybe 6% in some cases, and they were giving it away with zero down payment. Remember the zero down payment?
Yes,
and no doc loans, right?
Yeah.
Well, as soon as and then in April of 2008, I remember because interest rates went from like 4% in my savings account down to almost zero, and it practically overnight. And that's because this Federal Reserve came in and did quantitative easing. They bought up all the bonds trying to reduce the rates. And then the banks tighten up credit standards again. And so they're doing the exact same thing. And so I'm thinking if we look out forward, like your question, we're looking forward is that we now also see that the 30-year rate is right around 1.5, well, it's 1.46%. That is going to have to drop again.
Yeah.
It's going to have to drop. I wouldn't be surprised to see the 30-year rate get down to 0.5%. Wow. And if that should happen, we're going to see credit contract even further. And at that point, we're going to see asset prices decline significantly. In fact, and I hate to say it because I know it's not a popular view, but we're going to see crypto probably get hit pretty hard too.
And that's because of the dollar index compared to the correlation to the crypto market, right?
Well, yeah, not only that, but all asset prices. So we know crypto is an asset. We know stocks are an asset class, and we've got this tightening of credit standards. We're going to have a severe demand, a sharp demand for U.S. dollars. People are going to be scrambling for cash. In fact, this is one of the things that we talked about very early in the year. We knew this was coming because of what we saw last September when we saw the repo rates overnight go up to 10%. People are scrambling for cash; they don't have it. And so now we're going to see the second part of that, and probably something worse in 2008, 2009, when people start to realize that the Federal Reserve can't do anything about stock prices. They are not buying stocks, by the way.
Right.
I may have misspoke in the past saying that they're buying stocks. They're not buying them. I did a deep dive research into what the Federal Reserve was actually buying. They're buying the long-term end of the bond market, the U.S. Treasuries. They're buying the short-term. They're buying the mid-term. They're buying the 10-year. And they're buying corporate bonds, because here's a big issue with the corporate bonds is that almost 90% of corporate bonds are going to roll over into new revolving credit and term loans that are going to be coming due within the next 5 years. And if those have to be refinanced at higher rates, those corporations are going to go under. They're going way to the dodo bird.
Yeah.
They're just not going to survive. Mm-hmm. So they're keeping all rates low by buying the bonds. A lot of people have speculated, well, they're buying corporate bonds, and now the stock, corporations are out there buying their own stock back or stuff like that. They prevented banks from buying back their stock, but other corporations can buy back their stock. And so a lot of people think it's unfair, but the fact is that if interest rates even creep up a little bit here over the next 2 to 3 years, and all these refinancings are going to come due, and it goes up 2%, that's going to be devastating for the majority of the corporations in the United States. So my outlook right now is that we're going to see interest rates continue to decline. The Fed's going to try to stimulate lending, because if you can get a 30-year mortgage for 0.5%,
who's not doing that? Yeah.
I think, that's what their goal is. They want to see that credit expansion, and the only way to do is to lower rates. The banks are playing their part in this by restricting the credit standards, and they say, hey, look, it's just business, because we cannot lend to people that don't have the cash to pay us or don't have the outlook on employment. And so that's going to force stock prices to decline sharply, and probably lower than we saw back in March.
So let's drill down beyond the bonds and the corporate debt and all of that for a second. Back when this pandemic was really hitting hard and there was meat shortages, I covered and did a video on the idea of localized economy becoming the.
Yes,
you remember that? And I did an idea of, or at least a theory about that could be a way to jumpstart things, because everything is so broken that and people are so out of work that really through deregulation of, at the time, I used the example of meat and a farmer being able to sell commercially to the community, and then can hire people to work there to help that process, right? Because no longer are we counting on some huge conglomerate to deliver meat to the nation or certain parts of the nation, and that kind of a thing.
Right.
I mean, are we headed there? I mean, is this going to take a localized approach to re-stimulate the different areas of the economy? How else does this thing get off of the mat? Because we've yet to hit the mat. We're just talking about the fact that we're going down.
Yeah. So, I mean, there's kind of a slightly dystopian scenario there that you presented, because, I mean, we're going back to a local economy. Instead of globalization, we're going to disglobalization and more localization. And, I think that is a likely scenario, because, when we see credit contractions, when we see the lack and the ability of supply chains to move goods and services, it's going to be it's a real issue, especially when it comes to food.
Right.
And
doesn't it mean I got to run down to Farmer Bill's place, right? And I got to do some work on the farm, and he's going to give us enough meat for this week, right? I mean, I'm not saying that it'll be that bad, but I mean, that's a barter kind of scenario. I got to go give some energy and time to someone I know who can give me some good or service that they have to really get going. You know what's funny about this is, as dystopian as that is, right? We're really moving in that regard with the digital tech. Back in the day, money was seashells to a certain village, right? Money was deer antlers to another village. And then it took a village in between them that dealt with both to be able to get you what you needed in between, or furs, or whatever it happened to be, right? And now if you look at the digital world we're going to, as funny as it may sound, all these different tokens that are being created, private stable coins even, right? Not just cryptos, right? Central bank digital currencies. Aren't we back into that realm? We're moving back into where there's a currency for every single thing, and everybody can have their own currency, but we need that middle piece to be able to settle it all. I mean, just speak to that for a second.
Well, you bring up a pretty good point because, prior to like 1871, there wasn't really, I think it was 1871. I'm not sure exactly on the date, but there was a lot of local banks all over the country that printed their own currency. So it was the Bank of Cleveland or the Bank of Atlanta or something like that. And you had all their private currencies, and you couldn't take your notes, the printed notes from Bank of Atlanta, and take it over to Bank of Cleveland and try to get, some sort of exchange for it. And so in a lot of ways, digital currency and ICOs and new coins and stable coins that are coming up right now remind me a lot of that time period where just about anybody could print their own currency. And so that's exactly what's happening right now. The big question for me is, central banks, are they going to have one currency that they're going to be using to settle between themselves? I mean, that makes a lot of sense, because if the central banks can't hold it together, if they can't have a common unit of account for all of the transactions that are taking place on a ledger, then I think we're in real big trouble, because now you don't have any means of a conversion. You don't have a unit of count. You don't have any way of settling or knowing what is being settled, when and where, at what time. You're still in the same kind of situation where right now, where we're digitally settling and we're trying to write it down in a spreadsheet someplace, make sure that the other guy has the same spreadsheet you got. So you all your accounts match up and settle and balance, right?
That's right.
So I think they're really thinking about this issue. The biggest issue for them is, how are we going to settle these between each other? The other thing I saw that was kind of interesting recently was the fact that when a new currency was issued, so for example, back in the day in the 1870s, when the U.S. government said, "Hey, look, we can't have all of these different currencies in different regions of the country. We need to have one." So now we're going to have we're trying to form a Federal Reserve currency, a federal note that's good for everywhere in the United States. They never got to it until a little bit later, but they were working on it. They said, "Hey, we need this." And so, but when it first came out, nobody used it.
Oh, wow.
Nobody wanted it. It was funny because all of these regional currencies were doing, they were doing okay. You just couldn't swap them one with the other. But if you were in Cleveland, you took the Bank of Cleveland note, it was good, because it was what people were using. It was a common form of currency payment for payments. But when the Federal Reserve came out with their Federal Reserve note, nobody wanted it. And so what happens when the U.S. government comes out with a digital currency? I think the same thing's going to happen again. Nobody's going to want it. And we know it's good. We know it's going to probably solve a lot of the problems when it comes to settlement, but nobody's going to want it when it first gets introduced. And that's going to be, I think it's probably in the way we're developing the currency right now, the digital dollar currency. I think the way it's developing right now, it's going to come relatively soon. And maybe even the timing of it would just be amazing if this happened. But we get this drop in interest rates, we get stock prices declining sharply, and then we get the digital dollar.
Yeah.
And nobody wants it and nobody uses it. So it may languish. So what a time to buy it. I mean, the time to buy it is probably, when we get and it's not just that, but it's also, people always distrust things that are new, especially when it's come out from the government.
Oh my gosh, yes. I mean, yeah, I'll say. So, recently I saw a tweet, and I don't know how close it may or may not be, but it was, I believe, of Nancy Pelosi and some comments and remarks about Congress potentially creating that digital dollar and that digital wallet drop for the next round of stimulus. Now, I know that they're supposed to vote on it either this week or next week, I believe, if I'm correct. And
it got stalled again last night.
Okay, yeah.
It may go into the weekend without it.
Right. So that's interesting to me because, this addresses that bottleneck that you kind of covered here earlier. We've talked about this bottleneck, right? The printing and the releasing money and giving the bailouts and the quantitative easing, and how it all goes out to these upper level financial institutions and too big to fails. And the money doesn't come down to the consumer. And that's what really gets me thinking, okay, does this force us to move into more localized kind of economy settings? Because if the money doesn't trickle down to the consumer, how else does one begin to get up off the mat, right? Yeah. So, it's tricky. Go ahead, speak to that. Yeah.
Well, going back to your local scenario, if it comes out and the U.S. digital dollar is not widely accepted. So, for example, you go down to your local farm and they have a butcher shop and they're you can buy a cow for $450 in our area. You can buy the entire cow and just kind of carve it up, and if you got the freezer space, you can always store it. But I can see prices coming down significantly. I mean, you're talking about deflation. There was initial inflation in meat prices. I think they're starting to come back down a little bit again. Because there's not as much demand. I mean, meat's kind of expensive, right? So if you're going out and buying Delmonico and ribeye steaks, you're talking about $28, $29 a pound for a good steak, and that's kind of expensive for a lot of people. They can't afford it. And so what's going to happen is, can you imagine going down to the butcher and saying, "Hey, look, I want to pay you with the new digital dollar."
Wow. Ain't gonna take it.
No thanks. No thanks, sir.
I don't want
I prefer hard, cold cash, or, you got some silver on you.
Exactly.
Or you got a couple bottles of whiskey.
Yeah.
I mean, it's going to get to the point, I think, where, we're going to be talking about barter, because you don't have, people are going to be distrustful of the new digital dollar. What do you trade? So you have to trade with something, right? I think, and this is kind of a really talk about dystopian scenario. But if you think about it, I don't think the inflation period is going to hit until after we get through this really, really, really sharp deflationary period. So we're still on course for that. But at some point, you might want to barter instead of giving up your gold coins or silver coins, or, people won't accept the digital dollar in your wallet, or they won't accept the, maybe even, they won't take cash anymore because they're afraid of the virus and stuff like that. So what are you left with? You might want to just barter for it. So stock up on some whiskey and cigarettes, I guess.
Yeah, I know. It's pretty,
it's like wartime in Europe, right?
It is. It's like, damn, what do you make of that? I mean, and look, I mean, we're just trying to share with people, the things that we're thinking about, the things that we see. It's kind of a, it's like, hey, we may not, we don't know, right? But the other thing that I wanted to point out here is that, the IMF about a month and a half ago had the webinar where they had Barry Eichengreen, who was recently, the week before that, was on Blockstars. He said in that webinar that, the Triffin dilemma of the global reserve currency, and I'm paraphrasing, of the U.S. dollar needed to be dealt with. The entire webinar was about an external adjustment to the dominant currencies like the U.S. dollar, reevaluating that dollar. And you know what I thought about? I thought about the idea that if they lessen the value of that against other currencies, because you talk about how this deflation is so strong and running so hot, and if they literally go in and revalue the dollar to try to stimulate inflation, because the Fed has failed to be able to print to get in front of it. Your thoughts?
No, the Fed's not going to fail.
They're gonna get it done. They're gonna get the job done.
Let me put it this way. A lot of people have the misconception, and I'm going to have to shout out Stephen Van Meter, who's on YouTube, because he states this so eloquently and so well done. And his name is Stephen, and it's Van, V-A-N, and his last name is Meter, M-E-T-R-E.
Okay.
Go check him out on YouTube, because he says this so eloquently that the Federal Reserve's they say one thing and they actually do something else, is basically what he's saying. And he's not saying it because that they're liars, but the fact that they need to pump up the economy, but they do it in a way that's psychological. So for example, if they say that they're going out to do QE, which everybody interprets as stimulus to the economy, people will have confidence and will have the psychology that, hey, look, and they want to inflate prices. So they're going to, people want to go out and buy stuff now before the prices go too high, right?
Yeah.
So they're building confidence in the system. But the problem is they don't have any way of actually inflating the economy. In fact, if you look at what they've done since 1913, they have been depressing inflation. Wow. This is a completely different view than I had the last time we talked.
Yeah.
The last couple of weeks, I've been listening a lot to Stephen Van Meter about this, and he is absolutely 100% correct. I've done the research myself. I've done my own due diligence, and he is absolutely correct. Here's what happens when the Federal Reserve does QE. They can't go directly to the Treasury and buy the bonds. We all know that. What they do is they have their primary dealers go out and buy for them. And then what they do is they take possession of the Treasury notes and bonds, and then they create a reserve account in the name of the bank and the primary dealer and the large banks that provide them with the Treasuries. But the large banks and dealers can't access that money. It's a reserve account in their name only, sitting in a Federal Reserve member bank. Okay. And they can't go and take it out. They can only use it as collateral against a loan that they're going to provide, which means that the Federal Reserve, or the large commercial banks and the primary dealers that are supplying the Fed with the bonds, are taking cash out of the market, which is deflationary.
Right.
Not only are we taking cash out of the market, which is deflationary, but we're also taking out all of the defaults and the loan defaults and everything else that's going on in the economy is deflationary as well. In fact, Stephen and I had a conversation on LinkedIn about this. I asked him, I said, you talked about the deflationary scenario really eloquently. Defaults, corporate, personal, whatever it is, I'm assuming you're going to say that those are also deflationary. And he said, yes, absolutely. They are deflationary. So it's taking cash out of the system, not printing cash. And so what we're really looking at is the fact that the Federal Reserve cannot inflate the economy, despite what they say. They're only providing confidence to the system that they're going to be able to do that. And everybody believes it, but it's not true, because what they're really doing is they're taking cash out of the system. And that's going to be extremely bullish for the US dollar. It's going to be extremely, and everybody keeps saying that they're going to provide liquidity. They're not providing liquidity either. They're taking liquidity out of the system. They're leaving it up to the banks to lend money. The credit expansion is what increases the economic scenario. So it increases the economy. If they don't do that, then we're all in real trouble if credit continues to track. That's why interest rates have to go down. Right. In order to stimulate the economy, interest rates have to come down so people start borrowing again.
Absolutely. And of course, then you have the credit criteria and getting over that height bar with the banks themselves, right?
Again, yes, absolutely. So you've got this two-edged sword. And that's why I think there's going to be, at some point within the next, very, very close to maybe even before the election, or maybe at the end of the year, something I think within the next few months is going to happen that's going to be like an insolvency event, very similar to what happened in the great financial crisis.
Yeah, that's well said. Interestingly enough, speaking about insolvency means, we got to start fresh. We got to start all over again because it's broken. You're gone. You're done. You're flat busted. That's basically what we're talking about here. So
going back to your point, though, about being a reserve currency, when you really think about it, why has the United States engaged in wars all over the world? It's to protect the status of the reserve currency.
Absolutely.
Petrodollar.
Yeah.
And so in order for us, I don't think they're going to, no matter what, I don't know the individual who was making these comments, but the last thing, there's a lot of advantages, disadvantages to being a reserve currency. You're always going to be at a deficit, especially when it comes to imports, exports.
Absolutely.
But you're also going to be, there's a lot of advantages as well, because you can control just about everything.
Absolutely.
And so they are not going to give that up easily.
Yeah, it's a tough go, right? It is a tough go. Yeah. Interestingly enough, I had a smart guy tell me a long time ago that, this whole XRP thing was really about avoiding physical war because of the petrodollar issue. And that's always stuck in my mind as a very interesting point, right? It really
Absolutely.
is. So with that being said, let's shift gears to some of the news we've heard here in the crypto space, which is the SEC last Friday, I believe, issued a no action letter against security tokens, Dave. Now, you and I have talked about this. The first time we ever got together, we talked about this and the idea of how the market would be even bigger because of security tokens and the larger side of the market. This crypto business is just like, it's baby stuff compared to what we're talking about with security tokens. Talk about that.
Oh, absolutely. So when we met, I made the statement that, hey, now, we were talking about, hey, look, ICOs are not dead. They just have to figure out a way to keep it within the regulatory framework, right?
Absolutely.
And so STOs, same thing. Security tokens. What can happen? Well, the SEC is running a node on the XRP ledger. We know that from Adderley. I can't remember his first name.
Oh, Stewart, who made it very clear that, hey, look, the SEC is running a node. Why would they run a node? Because they want to see everything that runs through it, right? So if they are going to allow STOs now to enter the marketplace under a legal framework, then they are going to be the ones who want to maintain a ledger of every single transaction that goes on those STOs. And so it makes perfect sense to me. It's no surprise to either one of us that this is coming about. Yeah, I'll never forget the first time we met and you talked about it and you were saying the ICOs aren't dead and we're watching the SEC just like smash the daylights out. I was like, what do you mean? And then you were just like, well, maybe they end up, forcing all ICOs to launch on the XRP ledger because there's an SEC node there. And I'm like, mic drop. What? I mean, powerful statement. And I think really, really forward thinking on your part. It looks more and more like that as we move forward. Now, whether it goes on the ledger or not, I don't know. But you know what? I do believe that should happen because I do believe that regulators and agencies are looking for a one-stop, kind of a way-in truck stop and have everything move through a universal highway. How can you play a game of football if you don't have a field to play it on? We need a virtual framework to be able to have this happen. And that's why I've always believed XRP is not just a digital asset. It's a digital asset. It's a part of the framework of the entire digital asset space. Dave, go ahead.
Yeah, and not only that, but the SEC wants those fees.
Yeah, how about it? Don't forget the fees.
Yeah, all the exchanges. They don't want to stifle innovation. And why don't they want to stifle innovation? Because of all the fees that the CFTC is going to get and the SEC is going to get from the amount of transactions that go into STOs. So, just fractions, right? Just fractions, but still, man, those fractions add up quick. I mean, when you do, a lot of stockbrokers right now are doing zero commission fees, right?
Yeah.
But they still have to pay the exchange fees.
Absolutely.
So even though there's no commission, there's still an exchange fee on every single stock transaction. And so the government's going to get their piece. And the same thing with STOs. They can see the money. They can see the revenue streams coming in from those. And that's why they don't want to stifle innovation. They can see those fees coming. They want them.
Yeah.
They know that people are crazy about cryptocurrencies. And if they start to see STOs start to come out, they're going to jump all over them. I mean, look what happened with, what was it, Yam Coin and Sushi Coin and all these other coins that are coming up. There are millions and millions of dollars are going into those things. And, whether you like them or you don't like them, I don't know. I'm just saying that it seems like whenever something new comes out, millions of dollars flows into them. Yeah. The SEC's got to be taking a look at that and say, we can get a piece of that.
Yeah, absolutely. I'm reminded, I believe it was The Godfather, the movie, where it's like, I just want to wet my beak. You know what I mean? Dave, let's final thought this thing because the government's always going to get theirs. What's your final thought?
Look, I think everybody just be aware that, try to get rid of your debt, save cash, try to ride this out. I think we do have the deflationary period coming stronger than it was before. And the Federal Reserve does not inflate, it deflates the economy. And I think that's what they're looking for until interest rates probably drive on the 30-year, maybe zero even, or, that would be incredible. And then at that point, we're still going to have the hyperinflation scenario. So everybody be prepared, because you know what? We're not out of the woods yet as far as asset prices, including crypto prices. We're going to probably see another dip in I don't know what the prices are. I'm not going to predict any prices, but we are going to see another dip. So save up your money. And but on the other side of this is going to be a hyperinflation that you don't want to miss.
Wow, that's incredible. And I must say, the explanation about the Fed and about how they can't really stimulate anything, they can basically, the way I'm taking it, is just like a huge investor or venture capitalist does. They just talk their book.
They talk their book. That's exactly right.
They are
trying, and that's what that's the only thing that the president can do. Try to stimulate stock price. They think stock prices are, indicative of a healthy economy, but they're not really.
Yeah.
So you've got this, dichotomy, and the one thing about the Federal Reserve that is really, really interesting is that they can only take liquidity. They can only take U.S. dollars off of the market to reduce interest rates. Now, here's something that also Stephen Van Meter said, which I think was really, really interesting, is that I'm watching it, if there was ever Congress passed a law saying, hey, those reserve accounts that you have there for Chase Manhattan or Bank of America or whatever at the Federal Reserve Bank, they can access those now as cash. That would be super hyperinflationary.
Oh, wow.
It hasn't happened. That's one thing I'm going to be keeping an eye on. That's for sure. And I hope Stephen is out there and he continues to report on that, because he's done an absolutely incredible job of doing it so far. But if that ever happens, and it could happen sometime in the next 3-5 years, that's hyperinflation territory. And that would be amazing. We'll probably see asset prices at that time at bottoms. They release that cash into the system. That's hyperinflationary, and the prices are going to skyrocket. That's the time to make money.
Yes, indeedy. I love the sound of that, and I hope everybody braces for any kind of impact that we may have. I want to remind everybody really quickly to check out the links in the description. There may be something in there that you want for yourself, and to check all that stuff out. There's Ledger Nanos, there's Unstoppable Domains, all that great stuff. And I wanted to shout out Dan from Tradingology, because that's somebody you work with. Dan is awesome, and you guys
absolutely
work great together.
Dan is the man.
Absolutely.
What I tell you. The sharp guy, really nice guy. He's got all of my courses that I did on trading, back in the day. I used to do a lot of day trading, and, I just did a ton of, going all the way back to 1987. I started just before the crash in 1987. And I don't know if I ever told you this, but I was written up in Barron's Magazine for a trade I made in June of 1987.
Oh, that's fantastic.
Yeah, I was about all the money I had. I bought all the puts I could buy because I knew the market was going to go down. And they ended up expiring in September, and then we got a 50% crash in October. So
wow.
I lost my entire bet, but I was right about the stock market declining.
Wow.
At least.
Wow.
Anyway, I was written up in Barron's. Alan Abelson, the editor, had written me up saying that I bought a bunch of puts. And that was one reason why the stock market wouldn't go down, because a retail investor bought puts.
Wow.
Yeah. And so I go, okay. And then it went down 50% in October.
Those are the best lessons, even though they hurt the most, right? I mean,
that's absolutely right.
Yeah.
Anyway, shout out to Dan. Dan has all my courses, all the trading stuff that I've done over the years. He's got them at Tradingology. So you guys go check that out.
You got it. Dave, have a great weekend as always. Appreciate you, brother.
I appreciate you. Take care.
You got it, buddy. Take care.